Hello and welcome to another video. Everybody wants to make money on their investments. Throughout our lives, we cherish to grow rich one day and enjoy all the luxuries of life like rich people do. Then why is that some people make a lot of money while some cannot? Are you the one who think that you are not making enough money on your investments? Then don't worry. This video is for you. Stay with us and you will learn a lot. The value of time. Time is the most precious commodity. All of us have the same 24 hours every day. And it is how we utilize those 24 hours that makes the difference between how much money we make. Every return on investment is calculated based on time. For example, if you have bought some property for $100,000 and it doubles in value, you will get a 100% return on your investment. But whether the price of property doubled in 1 year, 5 years, or 10 years makes a lot of difference. You could multiply your wealth many times if you bought a property and sold it at double price every year compared to if you bought a property which doubled in price after 10 years. Therefore, always keep the value of time in mind when you make an investment decision. The value of compounding. Have you ever heard the term CAGR? CAGR stands for Compound Annual Growth Rate. All the growth in your investment is calculated based on how much of your wealth is growing each year. For example, if you are growing your wealth at the rate of 10% each year, then after 5 years, you will have 1.6 times of what you had in the beginning. This means that your CAGR is 10%. The higher CAGR you have, the more wealth you will accumulate over time. Share prices of companies whose revenue and profits are growing over the period tend to rise at higher rate than those companies whose revenue and profits are stagnant. Similarly, you will not be able to make a profitable investment every time. All of us, even the biggest companies in the world, sometimes get it wrong. So your CAGR over a longer period of time will depend upon how many profitable investments you have made compared to your loss-making investments. One of the biggest reasons for your slow growth is your loss-making investments. The rate of return. Whenever you make an investment, you anticipate how much profit you are going to make out of it. Your profit divided by your principal investment is your rate of return. Consider this. You see two investment opportunities in stock, A and B. Stock A is priced at $20 and stock B is priced at $25. You anticipate that stock A price will rise to $25 and stock B price will rise of $30 over a period of 1 year. Based on these targets, stock A will give you a return of 25%, whereas stock B will give you a return of 20%. Rate of return of stock A will be 5% more than stock B over the same period. On paper, it looked like both stocks will give you a return of $5. But one stock is giving you a return of 5% more than the other one. Therefore, always calculate a potential rate of return on different investments and go for the one giving you maximum profit. Generally, low-priced items will be giving a higher rate of return than the high-priced items. Getting a higher rate of return consistently over a period of time will go a long way in making you rich. Consider this. There are 3 friends, A, B, and C started investment with $10,000 for a period of 20 years. A is getting a 10% annual rate of return. B is getting a 20% rate of return, while C is getting a 30% rate of return. After 20 years, A would have made $67,100. B would have made $378,000, whereas C would have made a whopping $1.89 million. Can you see the massive difference between wealth of C compared to A and B? This is the power of rate of return. A 30% rate of return gave C 28 times more wealth than A, even though both started with the same amount. How to get a higher rate of return? Have you ever made an investment which doubled in value? Perhaps, yes. But have you ever made 10 investments that doubled in value? Perhaps, no. The difference between those who make a lot of money and those who do not is that the former consistently make investments that translate into higher profits than the later. One of the ways to get a higher rate of return is dividing your investments into smaller targets over a period of time. Consider this. You buy a stock for 1 year at $20 and expect that stock to rise to $28 after 1 year. This will give you a return of 40% in 1 year. On the other hand, you buy a stock for $20 and expect it to rise to $22 in 3 months. This will give you a return of 10% in 3 months. Now consider repeating this 4 times a year. $20 invested for 10% return each quarter will translate into a return of 46% in 1 year. You made 6% extra in the same period. There is also a better likelihood of achieving smaller target compared to a larger target. Therefore, always divide your investment into smaller targets and smaller time periods. Also, we want to know what an ideal rate of return is. Well, it will depend on the overall market scenario, but if you are consistently making 30% or higher annually, you will be in the top 10% earners. There are very few years when markets give you a higher than 30% return. Although one odd time you may double your money over a short period, you will not be able to do it consistently. Over-diversification. Whenever you want to make an investment, there are thousands of options available. You may want to invest in stocks, bonds, commodities, or real estate. There are more than 3,000 companies listed in the New York Stock Exchange. Out of those 3,000 companies, you may like 100 companies and want all of them in your portfolio. But remember this: you have a limited amount of money, and the more money you earn over a period of time, the wealthier you will be. It is a famous old saying that don't put all of your eggs in one basket. This is true, but the converse is also true. Consider if you have 100 different stocks available in your portfolio. What is the likelihood of getting a 40% return on all of them to achieve an overall yearly return of 40%? Very low. Because some of them will definitely rise, but some may remain stagnant, and some may even put you in losses. Therefore, it is better to stick to 3 or 4 well-worked-out best-case scenario investments. This will not only make it easier for you to track your investments, but also have higher likelihood of generating higher profits. The stop loss. There may be some occasions when things don't go as per plan. Consider this. You purchased a stock for $20 to sell it at $22. But instead of moving up, it starts coming down. It has the potential to come down to less than $1, which will wipe out all of your principal amount. It is always a wise decision to cut your losses and move on. Remember this: if you do not make a loss, you will end up making a profit. But if you lose your principal amount, you will have to first recover that loss. One of the ways to cut your losses is to put a stop loss at 25% of your target profit. Like if you wanted to earn $2 from an investment, you can put a stop loss of 50 cents below your purchase price. If that price is hit, you exit from your trade no matter what happens. Although you will suffer a 5% loss, but you will be able to save 95% of your principal amount. Therefore, never forget to put a stop loss on your investment. Gain knowledge. Knowledge is power. Try to spend some time gaining maximum knowledge about your investment. The more knowledge you have, the better chance it will give you to make a profitable investment. Do not go on hearsay. Move with a plan and focus on your target investment. If you follow these steps, there is a high likelihood that you will be able to accumulate more wealth over a period and finally be able to fulfill your dreams. That's all for this video. We will be back soon with another one. If you like the video, please subscribe to the channel and push the bell icon for notifications. Till the next video, bye-bye. See you soon.